Never let one staff control these three things. I mean these three things. Never allow any staff to control it. Let me start with the questions. If one of your staff members disappeared from your business tomorrow, will you still be able to know how much money came into the business? Will you still know how much stock you have? And will you still know who owes you money? As in customers that are owing you money? If your answer is no, you need to pay attention to this video, because there is something every business owners need to understand. Trusting your staff is good, but designing a business that depends completely on one person's honestly is not good at all. It's not a good business practice. And I am not saying that your staff are thieves. No, that is not what I am saying. You may have the most honest employee in the world, but even honest people can make mistakes that can create problem for you tomorrow. So that is why you need to put some system in place. People can forget. People can misunderstand instruction. People can leave the company. And unfortunately, sometimes people can deliberately manipulate information that can affect your company, that can affect your business tomorrow. So today, I want to share three things. I mean, three things you should be very careful about. Yes, allowing one staff to control some of these things, or many, all of them, is very dangerous. You should be careful. And number three is particularly important for small business owners. Number one is cash and money collection. This is probably the first place I will look at. If one staff member is responsible for receiving money, recording the money, keeping the money, depositing the money into the bank, and reconciling the same money he has collected, you have created a very serious control weakness. Let me give you a simple example. Imagine you have a cashier. A customer pays 100,000 naira. The cashier receives the money. The cashier records the money. That is, record the transactions. The cashier keeps the money. At the end of the day, the same cashier count the cash, and the same person prepare the report and give it to you. Now, if you must be sincere to yourself, ask yourself these questions. Who independently confirmed that the 100,000 naira actually entered into the business? If the answer is the cashier told me, that's not enough. You know why? Because the person who received the money should ideally not be the one responsible for providing what happened to that money. Yes, there must be an independent person who will review and reconcile all of this. This is where something called segregation of duties become important in your business. In a simple English, it means don't give one person complete control over a transaction from beginning to the end of that particular transaction. For example, one person may receive money, another person can review the records of what that money is for. That is the transaction that belongs to that money. The bank deposit can be independently verified. The bank deposit can be independently verified. The daily cash can be reconciled. The business owners or managers can review the summary. You don't necessarily need 5 employees to do all of this. Even in a small business, you can create a simple checks and balance. For example, your cashier prepares the daily cash report. You or another person can be responsible for a review of all of this. The bank statement is checked against the records and differences are investigated. That is called accountability, not witch hunting, not accusing anybody. Yes, just having a system, because remember, the more money a person controls, the more important independent verification is needed. Yes, you must verify all of this. Number two things you must do is inventory or stock. Yes, you must have to look at this aspect. This is another area where many business owners lose money without realizing it. If you sell physical stock especially, please pay attention to this particular aspect. Never allow one person to be the only person who knows how much stock comes in, how much stock went out, how much stock was returned, how much stock was damaged, and how much stock is remaining in the warehouse. Do you know why? Because inventory is money. If you have 10 million naira worth of goods sitting in your warehouse, you are not just looking at the cartons and products. You are looking at 10 million naira of your business capital. And if you don't control that inventory properly, your money can disappear overnight without you immediately noticing it. Let's say that your record says you have 500 bags of a particular product. Your storekeeper says, yes, we have 500 units. You trust him. 3 months later, you check physical and discover only 430 pieces of that particular product, or 430 units. Where are the remaining 70 units? Maybe they were sold, maybe they were damaged, maybe they were returned by the customer, or returned to supplier rather. Maybe they were transferred to another locations if you have branch. Maybe there was recording error, or maybe something worse has happened to that particular variance. The point is not to immediately accuse anybody. The point is you should be able to reconcile what the record says with what is physically in existence that you are seeing. That's why periodic stock count, periodic stock reconciliations are very important. You should compare opening stock plus your purchase, that is additional stock you added, minus sales or issuance of the stock, equal to expected closing stock. Then now compare the expected balance with the physical stock that is on ground. If there is a difference, if there is a variance, then you can now investigate it. And please don't wait until the end of the year or end of every quarter before you do all of this. Depending on the nature of the business you are running anyway, you may need daily check, you may need weekly check, you may need monthly checks as the case may be. The bigger the risk, the more frequently you should monitor it. And here is another important principle that you must monitor. The persons responsible for the stock should not be the only person responsible for the confirmation of the same stock. You need an independent check. You need an independent review. Number 3 things you must look at is your business record and financial information. This is key. Now, this is the only one I really want business owners to take it seriously. Never allow one staff member to become the only persons who understand the financial stories of your business. Imagine you have an accountant. The accountant records all your transactions. The accountants prepare your bank reconciliation. The same accountant maintain your receivable. The same accountant handle your payable. Imagine that. The same accountant prepare your financial report and give it to you for you to believe. And when you ask what is happening in the business, the accountant gives you a number. You simply accepted it. My friend, you are the owner of the business. You are not an accountant, and you don't need to become an accountant. But you need to have a knowledge of what accountant is doing. Yes, you need to have enough understanding to review the numbers that accountant is giving you. You should know them. You should know how much you are selling. Yes, you should know this. You should know how much are we selling, how much cash we have, how much is in the bank, who are we owing, who is owing us, how much stock do we have in the warehouse, what are our major expenses, and most importantly, are we actually making money? Your accountant should help you answer all of these questions, but your accountant should not be the only source of the truth without the management involvement, without the management review. This is extremely important. You know why? Because your business can look busy and successful, but your financial position will be deteriorating and will be telling a different story. You may be making 5 million naira in sales every month, but perhaps your expenses are 4.8 million naira. Maybe customers is even owing you 3 million naira. Maybe you are owing a supplier 5 million naira. Maybe stock is sitting in the warehouse. Maybe cash flow is becoming a very terrible problem for you. So if you are only looking at sales, you may think business is booming. You may think business is doing well. You may think everything is all right. But the financial records could be telling you a different story. Be careful as a business owner. That's why business owners need financial visibility. They need financial orientation. Here is the bigger problem. When one person controls everything, the business becomes vulnerable. Let's say your accountant leaves suddenly. What happens? Nobody knows where the records are. Nobody understands the outstanding debts. Nobody knows how the bank reconciliation was done. Nobody knows what the numbers means, or your storekeeper resigned. Nobody knows the actual stock positions, or your cashier leaves. Nobody can explain the cash records. That's not a strong business system. That's dependence on individuals. Yes, your business should depend on system, not personalities. People are important, but system protect the business when people changes. Yes, when they leave or when they are on transfers. But does this mean that you should not trust your staff? No, that's not what I'm saying. Please don't misunderstand me. You should trust your staff. You should train them. You should empower them. You should appreciate them. You should create an environment where honest employees can do their jobs confidently, but trust should not be replaced with control. Think about it this way. When you enter an aircraft, do you say that I trust the pilot, let's remove all the instruments? No. You trust the pilot, but you have the system. Yes, you have system. You have instrument. You have procedure. You have checks. You have protocols. The same principles applies to business. Trust your people. Yes, I say trust your people, but build system around them. Build system around them. So what can a small business owner do in a situation like this? You may be watching this and saying, this guy, I only have 3 employees. I cannot afford a complicated accounting department. You don't need one. Don't need a complicated accounting department. Start small. For example, if one person receives money, another person can review the daily summary of the record that happened that day. Of the record of what happened that day. If one person manage inventory, conduct periodic independent stock count. If one person maintain the account, the owner should review the monthly financial report and bank reconciliation. If you cannot separate every responsibility because your business is small, then increase the frequency of your own review. That's very important. You may not have enough people to create perfect segregation of duties, but you can create management oversight. For example, every week you can review sales, you can review cash, you can review bank, you can review your stock, you can review your debtors, you can review your creditors. Even a simple Excel or spreadsheet can help you monitor all of these things. The important thing is that the information should not live only inside someone's head. Here is a simple rule to remember. Whenever you see a situation where one person can authorize a transaction, the same person receive the money or goods, the same person record the transactions and verify their own work, stop and review that process, because that is where business may have a control weakness. You don't need to accuse anyone. Just ask, what independent check do we have here? That one question can change the way you manage your business. That same one question can change the entire activities of that place. And my final message is this. Let's go back to ask these 3 rules, these 3 things we have mentioned so far. Number 1, we mentioned cash. Don't allow one person to receive, one person to record, the same person keep and reconcile the money without independent review. Number 2 things we mentioned is inventory. Don't allow one person to be the only person who knows what comes in, what went out, and what remains. Number 3 things, which is the last thing we mentioned, was financial information. Don't allow one staff member to become the only one person who understands the financial positions of your business. And remember, this is not about distrusting your employee or distrusting the person that is working with you. It is about protecting your employee, protecting your business, and protecting the money you worked so hard to build. You know why? Because when you create good control, you don't just protect yourself from dishonest employee, you also protect honest employee from false accusation. If the records are clear, if responsibilities are separated, if transactions are reconciled, then everybody knows exactly what happened. That is the kind of business you want to build. That is the kind of business you deserve to have. A business that can operate without you but is never controlled by one person. Trust your staff but build a system. Check your numbers and never allow one person to become the single point of failure in your business. If you found this video useful, like this video and share it with the business owners who need to hear it. And in the comment section, tell me which one is the most difficult for your business right now, cash or stock or record keeping. Subscribe for more practical lessons on bookkeeping, accountability, internal controls, and building a financially stronger business. I will see you in the next video.